Hi everyone, we are back with another lesson of bank reconciliation, and this is from a basic point of view. And I just have to make a reminder first of what is a bank reconciliation. Remember, the purpose of doing this is to ensure that at the end of the day, you are able to identify errors that have been made in the business by a bookkeeper or an internal accountant, and to also identify the mistakes that have been done by the bank. Basically the bank that the business is using. So that is the purpose. If you can understand that purpose, then you're good. So the process in which this or rather these corrections can be done is by comparing the cash book balance and the bank statement records. By recording the two, that is the correct process of reconciliation. There is an activity that I have that I want us to go through. It's a very, very interesting activity. It's also simple. And we will just make sure that as we go time to time, we will be doing some challenging questions. So as we do this activity, you can work in a pair or you can do it individually. It depends on your study method or a way in which you prefer to process content. So let's read the instructions. Activity, reconcile records. Work in pairs or individually. Use the information below to complete a bank T account. By now, everyone should know that that is a general ledger. The cash receipt journal, the cash payment journal, and the bank reconciliation statement. So, the four things that we need to do. And in a nutshell, we are also being told that basically to reconcile, you need to have done step number one, your ledger, step number two, cash receipt journal, step number three, the cash payment journal. And if you don't complete these three steps, then you cannot complete your bank reconciliation statement, which is very, very important, right? Don't skip to the last step before having done these first three steps. So in this lesson, we are going to do the first step, which is what? The bank T account. Okay, so by now I would like you to just draw a mini T account for yourself on your side and prepare that with a pen and paper, or you can even use your PC if that's the case. But looking at our information, remember we reconcile every single month. Even though it's not given to us here which month are they reconciling, but by transaction number two, we can see that the month of reconciliation is June. Okay, so keep that in mind, meaning from the 1st of June to the 30th of June, that is the month we will be reconciling. And if we look at our bank statement, that is the first thing we're looking at. We can see that in the bank statement of this business that we will be dealing with, there is interest that the business has earned. There is a deposit that is in the bank statement, but it's not in the cash book. So we have not yet recorded it in the business. And we also had bank charges. So these are the charges that, any bank would charge for the service that they give to us. So I think I did ask you to do this IST account on your side. Doesn't matter, it does not have to look like mine as long as you have this T account on your side. So let's start with our bank recon. Remember, your bank T account increases on the debit side and decreases on the credit side. And why? Because it is an asset. Keep that in mind. You don't want to forget, even when you're doing reconciliation, that your bank is consistently an asset. Okay, now let's look. Let's have a look. The opening bank balance is 18,000. That is the first thing we given in the information, or rather the adjustments. Okay, and it's a favorable balance. What does that mean? It means it's a balance that should be recorded on the debit side. So suppose that this was an unfavorable balance, which is something that you also need to understand. But before we even talk about that, let us then record our amount, 18,000 done. And then we record the date, which is basically the 1st of June. There you go. Opening balance, right? Now suppose that this is an unfavorable balance. An unfavorable balance means that there is a bank overdraft. Keep that in your mind. Think about it. Unfavorable. It's something that's abnormal, right? So that is a bank overdraft, and it has to be on the negative side of the bank. So in this case, it is favorable. We keep it on the normal, which is the debit side. Let's have a look at the second thing that happened. We have a cash sales received on the 3rd of June, 6,500. That is straightforward. You should not be confused when you have a look at this. Money was came into the business, which is 6,500. So we go ahead and we record that. There you go. So remember, a business can give services or it can sell inventory. The income that it receives from that will be a cash sale or a credit sale. Then the third thing says that cash paid into the bank on the 4th of June, 4,200. So the keyword here is into. Okay, this is not the cash that has been paid outside of the bank, but it has been paid into the bank, meaning that it is a transfer that we have received from either a customer for whatever service or product that we sold to them. So we go ahead, we do the same thing. The amount there was 4,200. And that is how you record the third transaction. Then we read the fourth one. Check to supplier or creditor on the 5th of June, 3,000. Now this is straightforward. A supplier is a person that you buy inventory from. Yes? Correct. Now, in this case, you cannot receive money from your supplier unless in rare cases. But in this case, it is straightforward. It's a payment outside of the bank. What do? We come to the credit side because this time we're paying money. That's how you record payments, money that is going outside of the bank. And let's read. We had bank charges of 250. Remember, these are charges that you wouldn't know during the month. The only time that you get to know these charges is at the end of the month. So we have that in the bank statement, it's 250. Okay, so we need to acknowledge that. So we go to our credit side. And then we record bank charges. Some of you could be asking me, but why is it on the 30th of June? Remember, it's something that you will always see at the end of the month. And that is why this is something that is assumed that you should know. Similar to interest that has been earned, right? We have interest that has been earned. And in this case, you should think about in which cases can a business earn interest? And if you think about it, you will understand that interest could be coming from investments, it could be coming from savings, right? But it is the interest that has been earned, meaning that it is income. So we go to the debit side of our business and we acknowledge the fact that we received income in a form of interest. And that amount was 120. Okay, and then the next transaction, a deposit of 1,800 appears on the bank statement. Does it appear? Let's have a look at that bank statement. Yes, it does. And we can see that this is the deposit not yet recorded in the cash book. Okay, let's read further, but not yet in the cash book. So with something like this, what do? You know that, okay, cool. I see it from the bank. Some customer must have sent this through an EFT or whatever, but we didn't have a notification that there's a payment that went through. So in this case, we only seeing it on the statement. So you have to think in the back of your mind that, okay, to a certain extent, I need to go to my cash books, my journals, and make sure that this is somehow acknowledged in the business books. Okay, but before we do that, on the bank general ledger, remember the general ledger is still something that belongs to the business. It's a record within the business. So we go there and we acknowledge this deposit. The date is consistent, so you don't need to write that again. Here's your deposit. And then let's look at the next thing. A check of 900 was processed or rather issued, but not yet presented to the bank. Now that's something that's the opposite, right? We know it's in our journals, but the bank doesn't know. Regardless, since we are doing this T account, it is important that we also acknowledge the bank. And if you think about it, something that the bank doesn't know, what does that tell you? It tells you